This is Dylan with LendSolid, and this video is on what is hard money lending. Hard money lending is a way for house flippers to borrow money to buy an investment property without using a traditional lender. Instead of going to a bank, they get funds to purchase the home from an investor or group of investors, known as a hard money lender. A house flipper might use a hard money lender instead of a traditional loan from a bank because they're a lot easier to work with. Most loan products are for homes that are move-in ready. If the property is a rehab, the world of loans becomes much different. There are some products that are available to house flippers, such as a 203K loan, but there's a lot of red tape involved with these types of loans since lenders view them as risky. As a result, home flippers might go the hard money lending route to avoid the headache of appraisals, underwriting, and inspections it would take to get a loan from a traditional lender. Let's talk about the mechanics of how a hard money deal works. The hard money lender either lends their own money or lends from a fund they collect from investors. For example, the hard money lender might collect money from different investors, offering them 10% per year return on investment. Then, the lender loans that money at 15% interest rate to a house flipper. That 5% difference between what the lender pays investors and what he collects from the flipper is how he makes money for facilitating the transaction and doing the due diligence on the deal. The flipper then uses these funds to buy the rehab property and perform the renovations. Oftentimes, flippers don't even buy houses that are listed on the market. If you've ever seen a sign on the side of the road saying, "We will buy your house for cash," it's likely this type of deal. So the flipper buys and renovates the property, and after the renovations are complete, the house flipper can do one of two different things. The first option is to sell the property, hopefully for a lot more than he purchased the property for. Then he can pay the hard money lender off and pocket the difference. The second option is to find renters for the home, refinance the property with a traditional bank to pay off the hard money lender, then keep the property as a rental investment with a normal, much lower interest rate. Either way, the hard money deal is short-term financing, so the house flipper will only be paying interest to the hard money lender for around 6 months, depending on how long it takes to do the renovations. So, even though the interest rate is high, a good house flipper can make great profits using a hard money deal. One thing you might ask is, what are the risks in a hard money deal? For the house flipper, there's a chance that the project will take longer than expected, or the renovations will go over budget. For the investors and hard money lenders, they would be in trouble if the flipper goes delinquent on payments or otherwise backs out on the deal. The loan to the flipper is secured by the property as collateral, so the lender would need to take possession of the property and go through a potentially costly foreclosure process. Also, like any other real estate investment, all parties could lose money if home prices collapse. If you found this video informative, please like this video and subscribe to the channel. And if you live in Maryland, Virginia, or DC and are interested in refinancing your mortgage or purchasing a home, feel free to go to lendsolid.com and fill out our contact form, and myself or another loan officer will be happy to help.